Hi, and good afternoon. Thank you for joining us for Power Play Tuesday. This Tuesday, we're going to be covering how to spot those red flags. And I have with me a special guest speaker this afternoon, Mr. Gary Lipsky. And he's actually a real estate entrepreneur focused on multifamily syndications and has acquired 3,000 plus units with a total value of $250 million. In addition to that, he's won the Best Real Estate Syndication Company by AAOA in 2022 and was recognized as the 25th fastest growing real estate company by Magazine Inc. And in addition to that, you may notice when he comes up here on screen a picture of his book actually in the background of his photo, because he's also the author of Best in Class and has spoken at countless conferences, sharing his vast experience and allowing that to contribute to his multifamily investing business. Today, we're going to dive into how to spot some red flags when investing into a deal sponsor. When investing, because a deal sponsor can make or break your deal. It doesn't matter if it's a great deal or if the sponsor isn't, you've got a problem. And that's why it's so important to properly vet your deal sponsors before going into business together. Knowing the questions to ask and the level of expertise that they need are critical. No one wants to invest their hard-earned, nobody wants to invest their hard-earned money into a sponsor's practice and have them not be accountable. And so I'm really excited to have Gary today talk about some of the red flags that you can look out for and avoid to invest your money the best. And without further ado, I'm going to go over just a few items this morning, starting with Quest Trust Company's disclaimer. If you've ever had a chance to attend our classes, you'll often see our disclaimer, because Quest Trust Company does not give tax, legal, or investment structuring advice, nor do we endorse any products, services, or investments. All of the materials that you'll see in our presentations or shared by our guest speakers are for educational purposes only, and all parties are encouraged to consult with attorneys, accountants, and/or their financial advisors before entering into any type of investment. Quest Trust Company also has a few promotions running this November, and if you haven't heard, you can take advantage of setting up your self-directed IRA and having that first investment on Quest by having us actually add a $125 fee credit to your new account by utilizing the promotion code NOV125. Again, that's coupon code NOV125 is the coupon code, and that will allow you to set up your self-directed IRA and receive that fee credit to pay for your first investment out of the account. It doesn't get much better than that, folks. Quest Trust Company really prides ourselves on being a leader in education, and that education comes from our IRA specialists, but we also partner our education with various experts in the industry like Gary. And so if you're interested in taking advantage of some of the education Quest Trust Company has to offer, you can do so by checking out our videos. We have a YouTube channel. In addition to that, we also have blog posts, classes, and our website's just full of frequently asked questions. But if you don't want to go hunting for a bunch of education, let us tailor that education for you with a one-on-one consultation. You can schedule your consultation with a Quest Trust Company IRA specialist today, utilizing the QR code on your screen or by contacting our office by phone. So don't forget that you can take control of your financial future today with a self-directed IRA, and you also can come and join us at the Quest Expo coming up in 2024. This coming June, we are hosting the Quest Expo. And if you have not attended it personally, then you should. And we have tons of clients who attended our last Quest Expo and are coming back, and they're coming back for one reason and one reason only. And that's because this is the largest alternative investment expo out there. And they're not selling investments. They're only providing education on all these various investment options out there from various industry experts. So look out for the Quest Expo and take advantage of the early bird ticket sale prices that are available through December 31st. So this month and next month is your deadline to purchase those early bird tickets. So pick one up for yourself, pick one up for your wife and your neighbor next door, because you can help others build wealth too, just by educating them on self-directed IRAs. So let's change the world together, Gary, and go ahead and bring up your presentation this afternoon to help others invest their funds with the right people.
Sounds good. Thanks, Rebecca. Well, hi everyone. I hope to give you a few takeaways that will help you become a better investor. And it's not about the fanciest deck or the highest IRR. Rebecca mentioned it earlier. It's about investing with really good sponsors. So hopefully, like I said, you'll take away a few key things from this webinar. Quick overview about me. Rebecca covered pretty much everything. We focus on a couple markets, the Southwest markets, where we've done incredibly well. Like she said, we were recognized by the AAOA as one of the best real estate syndication companies in the U.S. and one of the fastest growing real estate companies in the U.S. I've been a real estate investor since 2002. I've invested as an LP and also as a GP. I've been an entrepreneur my whole life, and I started a nonprofit. And a previous company I had worked with underserved youth. We worked with 9,000 students across Southern California. So let's talk about sponsors. So one of the key things to look for is someone that has a track record. How many deals do they own and operate, not just invested or raised in? There's a lot of capital raisers out there, and they're a bit removed from operations and maybe not do really good due diligence. Now, there's plenty of capital raisers that do that, but again, they're not the operator. They're removed. So just be aware of that, who you are investing with. There could be some really, really good capital raisers that do that due diligence. You also want to make sure whoever you're investing with has market cycle experience. Now, what I'm talking about is, have they gone through a downturn? And maybe it's through real estate, maybe it was through another business, but you want to make sure that they have that experience. They've taken a punch, because people react differently when they take a punch, when things go badly. And I'll get into it more a little later on, but that's really important. Because when things are going great, like the last few years, it was easy to hit it out of the ballpark, to get 20% plus IRR. But when things get a little tough, people are now starting to talk about asset management over the last 6 months. But that should be a discussion from before you even take over property asset management. And whoever you invest with really should be allocating time, money, and resources to asset manage that property correctly. A lot of the bigger players will do that, but there's been a wave of smaller companies that have gone into real estate and real estate syndication over the last 5-8 years, and they didn't have the experience and the training to do that. The gurus out there teach you how to get your first deal, but no one was talking about how to manage that deal. And that's why I wrote that book, Best in Class. It allowed me to really fine-tune our systems and share it with other people. And you can find that book on Amazon or our website, breakofdaycapital.com. So it's important to know what issues has the syndicator, the operator, faced, overcome, and the lessons learned. Because no property goes perfect. Life doesn't go perfect. There's things that break down. there could be a fire, a Texas freeze, COVID, whatever it may be. There's adversity that you feel. I wish it was a smooth process the whole time, but that is never the case. So asking someone that you're looking to invest in, what are some of the toughest things that they've had face and how they overcame it is really important. You want to ask, have they ever lost a property before, investor money? Have they issued capital calls, which a lot of operators are doing these days? Have they paused distributions or performed below expectations? If a sponsor has a perfect clean record, they probably don't have enough deals under their belt, because these things happen. I mean, I would guess that pretty much everyone paused distributions during COVID. There's a lot of people that have paused distributions of late because maybe they have a higher debt service, or they've even issued the capital calls, which I mentioned before. So these are tough times for a lot of operators. So you want to ask and see how forthcoming they are. You don't want someone that's going to wishy-wash over everything. They need to be able to talk about the struggles they've had and how they're dealing with it. You also want to ask a sponsor, have they ever declared bankruptcy or been cited for SEC or FINRA violations or have bad credit. Now you can certainly do a background check, and I've got TLO is one of those options that you can do. Even just this first slide, if you do most of the stuff on this first slide, that will really help you. And I think most investors do not do that. So hopefully you can take a snapshot, or maybe they send out a recording of this. But those are some really important things. I'm going to move to the next slide. So you want to invest with someone that's got market expertise. So what I'm talking about is there are some operators that are looking for deals all over the country, and it's hard to be an expert when you're looking for deals all over the country. We focus on a couple markets, so we have thousands of data points. We know the brokers. We talk to them on a regular basis. If we're in town, we have coffee, lunch, whatever. We want to pick their brains and see what's going on. And so that's so vital. If you're doing it in 10, 15, 20 markets, it's really hard to have that personal relationship with the brokers that goes such a long way, and to really know what's going on in the market. And so you could be sent a deal in a new market, and hey, it looks great on paper, but you don't know all the particulars that have been going in the market. Maybe rent growth is going backwards all of a sudden. Maybe a major employer just left, and those are things that you won't know just from an OM. So that market experience is so important. Also, product type expertise is really important. So I would suggest, working with operators that, maybe focus on one or two asset types. So I've seen a lot of different operators start going to a lot of different things of late, looking for higher cash flow or this or that, but they're not expertise in that asset class. They're just picking it up and sending it out to investors to provide diversification, or they're struggling to raise on something else. So they're throwing out a bunch of different product types so they can get fees. Now, you really want to invest with someone that has many years of experience in that product type. You wouldn't go to urgent care to get heart surgery. You go to a heart specialist. So when you want to invest in multifamily, you want to go with a guy that's been doing it for many, many years. So another thing that's really important is full cycle experience. So if they don't have full cycle experience, that means they've only been doing it for a very short time, or they hold assets for a very, very long time. Most people target, maybe a 3 to 5 year exit. So hopefully they have some successful exits in that time period. And then this piece is a little bit harder, but evaluate whether the returns came from market conditions or operational expertise. Now, we sold 3 deals in the last couple of years, and I'll tell you, it was a mixture of both. Our IRR, internal rate of return, was super, super high. I can never promise those returns, but it was, we picked the right city, we sold at the right time, the market conditions were great. On our side, we picked the right property. Obviously, we picked the right city, and we executed the heck out of the deal. But to say it was one or the other was definitely not the case. It was like the perfect storm, and we were able to return a ton of money to our investors. But if you can, see over time, where their expertise lies, is it picking the right market, executing, whatever it is, and probably it's a mixture of things. You want to kind of get a feel for that operator. There's a lot of operators that had a lot of luck in the last few years and now are paying the price because they were just buying deals and not focusing on asset management and rode a wave, and that wave has gone out to sea. It's not coming in of late. So and you'll know if you've invested in deals and you're getting capital calls or the operator may be losing their keys. Unfortunately, over the next year or two, there'll be a lot of people that will be paying the piper because of that debt service. They bought deals with super high leverage, with tremendously high rent growth, without enough reserves, and now they're really struggling. They'll have to either give back the keys or sell at a huge discount. So let's talk lack of strategy experience. So executing a ground-up development isn't the same as a value-add or stabilized yield strategy. We bought garden office space a few years ago and converted to multifamily. We knew the multifamily space really well, so we partnered with someone that has that experience that we know, liked, and trust to bring that experience to the team, because we didn't want to take on that kind of project without someone that had that experience. We didn't have that experience, so it lent credibility to us, so we can go to our investors. So that's really important. You're making sure the whoever's on the team has that strategy experience for that property. So loan guarantee, is the sponsor or sponsorship team signing on the loan, or are they paying a fee to borrow someone else's balance sheet? So that'll be, that loan guarantor, KP, they'll get a few points on the GP side, the general partner side, to sometimes sign on a loan. And so that's really important. You want to make sure that sponsor has skin in the game. Are they signing on the loan? And even if it's non-recourse, and so non-recourse means, they're not personally liable unless they do something wrong. That's called bad boy carve-outs. If they do something illegal, then they'll be responsible. But you definitely prefer to invest with someone that the sponsor is signing on the loan, that has liquidity. If something goes wrong, they have some money on the sideline that they can they can invest as well to help cover shortfalls. All right, so lack of continuity plan. So again, you're going to see this more on the smaller companies. They may lack key man insurance. So if it was, let's say Joe, and he's got 2 other people, but there's no key man insurance. What happens if he's running the show and somehow he gets really sick, or even worse, he dies? Who's gonna take over from there? Is there money for someone to run the show if he's no longer there? Is there a continuity plan? Who's on the bench? Who can help run the show just as good as him? So that's really important, having that continuity plan. So investing with someone that, there's a team behind them is really important. Communication, so important. You want to keep investors up to date on a timely basis. So we'll send a monthly report with our KPIs, how we're performing against pro forma versus budget, and that, pro forma versus actual. And so our budget may change in the future because we'll work with the property management. Just because we have a pro forma, let's say for now that when we if we're buying a property right now, and that could change 2 years from now, 3 years, 4 years from now. But we want to use our original pro forma and compare it so that investors can see, and explain what's going good, what's going bad, and explain the solutions that we're facing. Like I said before, nothing goes perfectly. Of late, expenses have shot up. So in Arizona, where we invest, we don't have the crazy insurance and the real estate taxes that have plagued some deals in Texas. But certainly expenses have gone up quite a bit. Insurance has gone up about 10%. And typically people haven't underwritten a 10% increase, never mind a 50% increase in insurance. So you've got to communicate that to investors. Sometimes you'll have seasonal effects where come the holidays, your occupancy may dip. No one's really looking for an apartment during this time. They're focused on the holidays, and so you could offer tons of concessions, lower rents. It's still not going to make a huge dent in your occupancy at that time. And so you really want to be aware of renewals and push that in January. But that, you've got to make sure your sponsor is communicating. When something happens like a Texas freeze or COVID, is that sponsor doubling down on the communication, or are they taking much longer to communicate, as well? So that's something that you've got to look out for. You want to make sure you invest with someone that communicates clearly and answers all your questions on a consistent basis and is quick to respond. If you're talking to a new sponsor and they take forever to respond to your questions or only answer some of them, that's a good sign that they might not be the right fit for you. So everyone's seen this, and it happens time and time again, lack of a realistic deck. So someone might put in an overly ambitious IRR. Don't chase returns, chase good operators. Maybe they have a loan that matches their business plan or doesn't. It doesn't make sense if you're looking to sell the property in 3 to 5 years and have 10 years debt on that. Your prepayment penalty is going to be huge on that deal. And you'll also see a lot of people that when they underwrite, they won't include that prepayment penalty in their deal. And so that's a big problem. When you go to sell, they're going to have a huge hit to their returns. And, you want to make sure that that loan matches the business plan. I see a lot of operators distribute cash flow from raised capital. So they'll raise an extra $1 million, $2 million, and they'll have overinflated cash flow distributions, but it's really not cash flow because you can look at the NOI minus the debt service, and then you can see how much cash flow a deal really has. So you're just giving money to the operator to give it back to you, and so that's not a true cash flow. You also want to see real sales and rental comps. Certainly, when you're looking at an OM from a broker that's selling a property, he's going to pick and choose what sales comps and rental comps they use. Make sure the deck that you see has properties that are this, very similar, are close by, and depending upon how tertiary your market is, you might need to go further out. A big city like Dallas or Fort Worth, you might have comps that are much, much closer. And that's really important. The further out they get, the harder it is to compare. And so obviously you want to get as recent comps as possible. and see what was the cost per unit, what was the cost per square foot, because one property may compare a 2-bedroom to another, but that 2-bedroom may be 900 square feet and another property may be 700 square feet. So it's not apples to apples you're comparing. You also want to compare amenities to the property. What's the median household income in that area? What is the median household income? So that's also all very important. Rent growth. People probably didn't predict that rent growth would be flat in 2023, or in some cities go negative in Phoenix and some areas, other markets as well. So rent growth, just building in these buffers is so important. I'd rather underpromise and overdeliver, and that's someone that you want to invest with. You don't want to invest with someone that's promising the world. It's going to make it really, really hard to deliver. So I talked about expense growth a little bit. Making sure that expense growth, payroll has gone up tremendously, insurance, utilities. So having 3% rent growth in your deck isn't cutting it these days. You've got to be closer to 5%, maybe more on some items. And the CapEx plan, making sure they have plenty of reserves for even if they got a new roof or they new plumbing lines, whatever it is, making sure you've got plenty of money in reserves for things that may break, because it's not a question of if they'll break. Something will break, and then you got to make sure in your CapEx you have enough growth in costs as well. I think a lot of people have made that mistake where you're underwriting in 2023 for expenses that are going to occur a year or 2 years down the road, and not including that cost going up. And that's something that I've made that mistake when I first started. I didn't include enough growth in that CapEx expenses. But if you have plenty of buffer in rent growth, expense growth, CapEx reserves, you're going to have plenty of buffers in your underwriting to protect you, because maybe it's you getting killed by expenses, but you're getting decent rent growth, or you're getting killed in the CapEx. So you want to have lots of different buffers, because you don't know where you might get a punch from. So just having those buffers is so important. So like I said, hopefully you took away a few key things to help you become a better investor. Here's my information, but I'm happy to take any calls you may any questions you may have about what I talked about. Happy to help you. Oh, Rebecca, you're on mute still.
Thank you so much, Gary. So we're going to open up the floor for questions, and those of you who are attending online are able to actually submit your questions, whether they're IRA related, for myself to help answer as an IRA specialist with Quest Trust Company, or Gary to address as a knowledgeable multifamily syndicator. Let's see here if we have any questions. I haven't seen any come up just yet. This will be recorded and available on the YouTube channel. Roy has asked if you could comment on sponsor fees and what are the red flags when it comes to those fees.
Excellent question. Yeah, if someone's taking massive fees up front, they're probably in it just for the fees. So I think, you'll see a lot of 2% acquisition fee, which is pretty standard. When they start getting higher than that, when you're starting to see 2.75, 3, Maybe on a smaller deal, you might see a higher fees, but on a bigger deal, that percentage should come down. 2% asset management fee is very normal. Some people charge a refinance fee or a disposition fee. You just want to make sure there's not a lot of hidden fees in there. You also sometimes see a fee on if they're signing on a loan, if there's recourse debt, or sometimes even for non-recourse debt. So if they're killing you with so many different fees, that is a red flag.
I have one for you. Have you ever heard of an investor coming to a syndicator and asking them about transferring ownership from their traditional IRAs to a Roth IRA as part of a conversion? I see this a lot with some of our clients here at Quest Trust Company who may have invested into a syndication with a tax deferred account and then may want to do a Roth conversion so the profits will come into their Roth IRA tax free. In that regards, have you seen a fee charged for the drafting of those documents by, what attorney may be assisting the sponsor? I'd love to hear your input.
I haven't seen that. Maybe people do, but I've never had that.
It's a little bit specific to retirement accounts as an investment. So please excuse me. Let's see here. We have a question from Dolores Esperanza. She was asking if there's a list of syndicates.
As far as good sponsors, or?
I believe that is the underlying question.
Yeah. Well, I would suggest everyone's got to do their own homework. Certainly asking friends. There is a herd mentality. So once someone has one good deal with an investor, then they tell others, and that I've made that mistake as well. Like a friend has had one good experience where it's like, oh, this deal's good, and I'm like, okay, I'm really busy, I've got some retirement money, I'm going to invest in it, and I've been burned. So you got to do your own due diligence and get a feel. Look at the sponsor in the eye, ask them those questions, ask to speak to some of their investors, and get a feel for it, because you've got to make sure it fits your investment plan, and get your own feeling from that team.
I really loved what you were saying earlier about the different strategies, from improving to land development and everything in between. And those also offer different levels of risk, which, again, the investor may need to consider when doing their due diligence for an investment. We have another question here from Mr. Ram. Are there a lot of existing multifamily deals going through default?
So there's definitely a lot of deals that are struggling right now, but you're not seeing a ton going through default. That's something I wouldn't necessarily see, but the lenders don't want to take over the property. So they're trying to work it out with sponsors. Some may be worked out, some not. And so what you'll see is some of the lenders going to some operators that they've enjoyed working with, that they know that are good operators. So they'll kind of sell the deal, kind of behind the scenes without forcing someone through default or whatnot as well. So there won't be a tsunami. I think a lot of people are waiting for all these great deals to happen because people are going to be forced to sell. I think there'll be some workouts. There'll be some deals that happen behind the scenes. But yes, there are a lot of deals that are struggling, but conversely, there are a lot of deals that are still performing very, very well too.
Thank you so much. It looks like we have another question from Mr. Lee. Can you elaborate on adjustable rate mortgage with cap protection purchase?
Yeah, so a lot of people, they bought, and I did myself. I bought, floating rate, bought properties with floating rate debt, and you've got to make sure your cap rate protection last as long as the loan, or because some people have only 1 year of protection. And so once that, let's say your rate was 5% and your cap was at a 6 or 7. So once that loan rate goes above it, that insurance policy kicks in and covers you for any overage. But once that expires, you're paying that difference, and that can really sink you because you can't refinance because you're overly leveraged. So you need to either put in a lot of money or you give back the keys. And so people that their cap protection expired, they're hurting right now because it's very costly to buy that cap down. So you're seeing people doing the capital calls, halting distributions. But it's very, very important that you had that protection for the length of your loan when you bought the deal.
Good to know. Good to know. That looks to be all of the questions we've had come in thus far. So I have one last one for you. It's also IRA account related, but it's one that I went to my first syndicated investment with. And it's because IRA accounts can have taxation generated by doing investments into entities that could pass through taxation to the shareholders. So one of the questions that I went to my syndicator with was, is this a pass-through entity or is it a CCorp that's going to pay taxes at the corporate level? Because it wasn't clear to me how they were planning to handle the taxation for the investors. Most of the time, I know they go through the pass-through strategy because that works a little bit better. But do you ever see folks utilizing a CCorp for IRA investors so that that corporation can pay taxes at the corporate rate instead of trust rates, which is what unrelated business income tax would cause?
Yeah, that's for me, correct?
Yeah.
Yeah, I haven't seen people do the CCorp. That's pretty interesting. I think a lot of people that invest with cash, or they're looking for that bonus depreciation. That's a big selling point. So, and UBIT tax being relatively small, that's a little price to pay for people that invest through the self-directed IRAs or Roths. So that seems to be the norm. But someone can invest. We have investors that some do cash, and then also with their IRA too. So they have they have the kind of best of both worlds. They have the tax write off on some of their taxable gains, and then they also have the tax benefits as well through the IRA. So lots of different strategies that people can use. But the UBIT tax, I know people get really fearful of it, but it ends up being a pretty small.
Yeah, it means you're making money.
Yeah.
If you have that tax, I think that's one of the easiest ways to drive home the point that everybody has this expense with investing, whether you're investing personal funds or you're investing IRA dollars. And so just being aware of that expense can allow investors to best plan. It looks like while we were chatting, we got a few more questions here. Starting with Mr. Ram, if a multifamily is not performing, what are the options to get out of it?
Yeah, Ram, that's a good question, and you're very limited because it is an illiquid investment. You're starting to see opportunities out there where there's an opportunity for it to be more liquid. There's some platforms out there. I haven't done a lot of research on there, but obviously if something's not performing well, the value has gone tremendously. If it's gone up, you need to sell, you're not going to get the maximum value out of that deal. Sometimes you can go to the syndicator, the operator, and say, hey, I'm looking to get out. Maybe they'll work with you and open it up to other investors. And if it's performing well and the value is 100, maybe you could sell it for maybe 90,000. If it's performing bad, then you're gonna take a hit. But That's with any investment. But typically that's the one thing. It's not like the stock market, but the benefits are it's a great hedge against inflation. It's a hard asset. You can force appreciation. This is, pretty much all my money I invest in multifamily because of the reasons I have said, and the bulk of it is through cash, and I still have some retirement money that I use that I invest in deals as well. Not my own deals, but in other people's deals.
I think you answered that really well. I wanted to add on from an IRA perspective. When we see account holders' investments maybe not go as planned, there are procedures to actually devalue an investment as well. Of course, you can try to get out of it first by going to the deal sponsor. I know I had to do that with my very first syndicated investment because I wanted to go buy a house and needed some of that money. But you may have other priorities that take you towards wanting to get out of a particular investment. Let's see here. We have a few more questions. Next, we have Marsha's. What is a multifamily sales market like now?
It's pretty cool. There's cool. It's not a lot of deal flow. We're heading into the holidays. The last year you're looking at transactions. I don't know the exact percentage, but it could be down 75%. There's just a gap between what the buyers are willing to pay and what the sellers are willing to sell their property at. For us, we're going to be closing on our first deal in a year. We just haven't, we put out offers on things, but the price that they wanted was more than what we were willing to pay. We did the previous year, we did over 132 million in deals. So it's just, that's the way it is. I do expect that to pick up next year. We'll see interest rates drop, which will get deals flowing again. People will have to sell. There's a ton of dry powder sitting on the sidelines too, waiting to get in deals. So it will definitely pick up next year, and that'll be good for investors as well, because they have a lot of money tied up in deals and want that flow so they can start investing in other things as well.
Wonderful. It looks like we have another question from Roy. I have on occasion been asked to be a KP to get my balance sheet for a loan. What are reasonable incentives between management fees and promote?
Yeah, so what you'll typically see is a GP may allocate 5% of the whole GP towards signing on the loan. So depending upon your balance sheet, maybe it's, if it's a $10 million loan and your net worth is 2 million and someone else's net worth is 8 million, maybe you get 2% of that 5%. So that's what I've seen in the past. If someone is desperate, they might, give you more fees, but it is negotiable. But I would suggest, because I know people that have gone burned where in the past, when things are going great, they're signing on loans, they're getting some fees, but when things go negative, now you're responsible. Particularly if it's recourse, that's gonna be a mark on your credit, or you're gonna have to put in some more money. So just be careful if you're a KP. I know it looks like easy money when things are going well, but make sure you really know the operator. Make sure they have skin in the game as well to protect yourself.
Awesome. We have just one more question, and I'm really excited to hear your answer because I also oversee our inherited department. And Mr. Musa asked, are the heirs obligated to stay in the syndication or fund after the original investor's passing?
So thankfully, I've never had to deal with this before, but the way I understand it, yes, it's not a liquid investment. So unfortunately, you do have to wait until the fund or the syndicator sells the deal, and then those assets will be liquidated.
And that's exactly correct. So from what I see with IRA accounts and the passing of wealth on to the beneficiaries of that IRA is that normally there's a stock powered transfer that will transfer the shares, for instance, over to the beneficiary's inherited IRA, where it can stay within the IRA account tax shelter, or they could distribute. I've also seen some syndications receive notice of the account holder's passing and decide that they were just going to pay out that individual investor so that their beneficiaries wouldn't have to go through all that trouble. And that was also partly due to the way they drew up their agreement. So I'd say that honestly, it's going to come down to talking to maybe the syndicator a little bit about what the process would look like for your beneficiaries. And then also don't hesitate to give your self-directed IRA custodian a call, because more than likely they have an inherited department ready to help you analyze those questions. That concludes all of our questions. Thank you for letting me give an inherited department plug. I want to encourage everybody to continue to join us for educational content, or to check out our website at questrustcompany.com for more information or events coming up near you. Thank you again, Gary, for your time and joining us.
Thanks for having me, Rebecca.